So we've recently seen the fastest correction in the stock market ever, with a 10% decline occurring in just 6 days. And if you've been investing for some time, these are likely the most volatile markets that you've seen since the financial crisis. And for many of us, myself included, these are likely the most volatile markets we've seen in our investing careers. Now we have a lot to cover in this video, including putting this volatility into a long-term context and discussing some strategies that you can do to build a robust investment portfolio. With this video, we'll be trying out a new podcast format, which some of you have requested, and then we'll get back to more regular content later this week. I'm modeling some of this podcast similar to Joseph Carlson's show, another investment YouTuber, so if you like this style of content, you can definitely check him out as well. And also, I want to quickly say thank you for 50,000 subscribers. Your support honestly means more than you know, and I'll do my best to continue delivering you interesting and informative content. So with that, let's jump in. And the first thing probably we want to discuss is simply the magnitude and speed of this recent market crash. Now, I've mentioned that this is the fastest correction ever occurring, 10% decline or more in just 6 days. And what's interesting though, in my perspective, is that not only is this the fastest market correction, but the second fastest market correction was the one we saw back in February of 2018. This is signaling to me that markets in general are becoming much more volatile and move more quickly than they have in the past. But why exactly is this occurring, and what's causing so much market volatility? Well, interestingly enough, we've discussed this a bit in the past, particularly regarding Michael Burry and his claim on what he believes is called the indexing bubble. Now, Burry made many points in that discussion, but a simplified version is as more investors are investing into passive index funds, you have fewer investors and less money actually being used to value these companies based on a fundamental basis, and more money just being put into an index that doesn't look at the valuations of the underlying companies. Because indexing is passive and there's no active adjustments made, indexes can become overvalued over time and trade at high valuations relative to historical norms. Add into the fact that today now more than ever, we have algorithmic trading and also momentum and quant trading, which can very quickly exacerbate small market moves into much larger ones if there's an increase in volatility. So if you combine the fact that today now more than ever, we have the most investments in passive indexing vehicles, we have more algorithmic and momentum-based computer trading than ever before, and also combined with the fact that valuations now, in terms of both the stock market and the bond market, are at some of the highest points in history, in that context, it doesn't really come as that much of a surprise to me that we're seeing markets so volatile. Is the speed shocking? Certainly yes, but does it come as a surprise for me? Not really, and I don't think it should come as a surprise for you too, and going forward, understanding that this is the context of the market that we're operating in, you should be aware and mentally prepared that this kind of volatility isn't just some abstract risk, but it can and does occur. Now, taking a step back, weeks like this can be quite unnerving even for the most experienced investors, though what helps me and what might also help you is understanding and knowing the fact that when we're investing this money, that we won't need this tomorrow or next year or even 5 years from now, but we're really investing for the long term. So if you frame your decisions in the context of the impact that it'll have financially for you 10 or 20 years from now or 30 years from now, it makes it a bit easier to handle emotionally. So I generally think the best way to handle market volatility is not to take reactionary, emotionally driven actions, but to put on our long-term rational thinking cap and ask ourselves, in today's environment, what are the steps that I can be taking now to better position myself 20 years down in the future? And we'll get more into those strategies soon, but what I want to discuss next is valuation, and that's a very important topic for several reasons. The reason it's important to keep tabs on the overall valuation of the market is because that's really the only gauge you have as to whether, based on fundamentals, that the market is either expensive or cheap. Looking at the price of a stock or price of a stock index alone doesn't give you that determination of expensive or cheap. A stock can be at an all-time high and be quite cheap relative to fundamentals, and alternatively, a stock could be at an all-time low but be very expensive relative to expected future growth and earnings. By always asking the question of valuation, you can become a better investor over time because you're not just looking at the stock price, but you're actually looking at the underlying business fundamentals that drive the value for the stock long term. With that, I just want to take a few graphs that give a relative sense of where we stand now on overall market valuations compared to some previous times in history. Now, one of the things this graph is showing is what's called a cyclically adjusted price to earnings ratio. And what that effectively is, it's how much you have to pay to get $1 of earnings or profit. As an investor, you benefit more from lower valuations because if you invest at lower valuations, you're getting more bang for your buck and you're getting more profit for your investment. Inversely, if you're buying at higher valuations, you're getting less earnings for every dollar invested. This means there's more risk because not only are your expected future returns lower, but you also have the risk that valuations of the underlying security might come back down to more historical averages. This, in some cases, could cause a significant price decline in that security, potentially similar to what we're seeing today. From this graph, you can see that the US market is at one of its 3 most expensive points in history since 1900. The other two being the dot-com bubble of 2000 and the stock market bubble of the 1920s. Now, neither of those ended particularly well for investors who were investing at or near the top of those bubbles. In the aftermath of the dot-com bubble, the S&P 500, representative of the general market, dropped over 40% from peak to bottom, and the NASDAQ, which comprised mostly of technology stocks that were the core of this bubble, declined almost 80% from peak to bottom. In 1929 and following through the Great Depression, the overall peak to bottom loss of the market at that time was 90%. So if you invested in the top of the market in 1929, at the worst decline, you would have just 10 cents left for every dollar invested. And I don't necessarily think we'll see a 90% decline going forward, but I think it should stand as a stark reminder that large percentage declines are not by any means an impossibility. To give you a sense of what a potential decline might look like, and also with the context of where valuations would be at each point, I want to take a look at this graph which I've created, which is a graph of the S&P 500 over the last 13 years with various price levels highlighted. From the top, we'll see what it takes from a valuation standpoint to get us to various declines in the S&P 500 and what that could potentially look like going forward. So earlier in February of 2020, we were at the market high and also had very high valuations as well. The S&P 500 was roughly 3,400 and a price to earnings ratio of roughly 21. Again, meaning you'd have to pay $21 to see $1 of profit from the underlying basket of securities that you owned. At the beginning of March, following the fastest correction on record, we were down 13% from those all-time highs, now standing at roughly $29.50 on the S&P 500, and assuming that earnings remain the same going forward, we're now trading at an 18.5 price-to-earnings multiple. And this is again another reason why valuation is so important when investing, is because when you're buying something at a higher valuation, you have to understand implicitly that there's downside risk if that valuation comes down or reverts, especially if the stock or security or index is at a valuation level that's higher than its historical average. Now, price to earnings ratio of 18.5 for the market is still relatively high. I would say a normal price to earnings ratio for the S&P 500, and I'd say for many stocks in general, would be around 15. Obviously, there will be some stocks that are growing faster and likely will trade at higher multiples that could be justified, and other stocks that are growing slower and may trade at lower multiples. But overall, a price to earnings ratio of 15 has been a historical average. To get officially to a bear market, we would see the S&P 500 at roughly 2670, now then at a price to earnings ratio of 16.5, which would represent an over 20% decline in the market. Interestingly enough, this would get us back to the same price level as the end of 2017. To get back to those normal valuation levels of 15 times earnings, we would need to see a decline of almost 30% and the S&P back to 2,400. This would roughly match the lows that were seen during the stock market crash back in December of 2018. However, if we see a 30% market decline, it's unlikely that earnings are going to stay the same, It's more likely that in this scenario, we've seen some sort of economic slowdown, potentially a recession, which also brings a decline in corporate earnings. So if we enter a scenario where earnings are down 10% and the market is trading still at that normal valuation of 15, well then that would translate to a roughly 36% decline, and the S&P would now be at roughly 2,200. This would effectively bring us back to the level that we were prior to the 2016 election. And here's where we start looking at a few of the more serious or adverse situations. For instance, if we see a 10% earnings decline at what I would consider a low valuation level at a price to earnings ratio of 13.5, this would represent a 42% decline, which would bring us back near the lows that we were at in 2015 and 2016. And in the most serious scenario highlighted here would be a 50% decline from all-time highs. Now, assuming current earnings remain the same, this would be roughly a 12 price to earnings multiple, with the S&P 500 at 1,700. Now, if we were to see one of these declines of 40 or 50%, it's likely that this would be a very scary time to invest. However, long term, it likely would be very beneficial. Another one of my favorite graphs is taking a look at the cycle of a market bubble, which graphs the valuation of the bubble over time and the emotional phases that investors go through during this bubble. At first, there isn't a lot of excitement, and valuations remain relatively in line with fundamentals. However, as the price starts increasing faster than those fundamentals, the valuation increases, and that's when we start to see enthusiasm, greed, eventually delusion, and then you start hearing people say that this time it's different. This time we're not in a bubble. This is a new paradigm shift. See, everyone who's worried about valuations, you don't understand that we're in a new era where valuations don't matter. And it's at this point you hit the peak of the mania phase, and this is when it's all downhill from here. When everyone who's already been emotionally caught up has bought, there's no one else left to buy at these excessively high valuations. Now, the valuations might not crash immediately all at once and may come back up for some time. However, over the long run, they will come back down to those fundamentals eventually. And this is when you see serious market crashes as that investor emotion changes from denial to fear to capitulation and eventually to despair. And it's during that final despair phase when the last person has panic sold their investments that there's no one else to sell at those depressed valuations, and then the buyers start coming in. Those buyers ideally being investors like you and me, well, not going to time the bottom exactly, obviously, but investors who have a sense of where valuations stand relative to the price and can recognize a good value when you see one. Going back to our graph of the S&P 500 with our valuations, right now it looks like we're in the early stages of a capitulation period. This capitulation can continue for quite some time, and I'd say only unless we break below those normal valuation levels of a 15 price to earnings multiple would we really only start getting into the despair and final stage of the market cycle. But those are just my thoughts on it. I'm interested to hear where you think we stand in the market cycle. But with all that, let's discuss some strategies that we can use to help build a robust portfolio and help manage the risk during these volatile times. Now, if you have a long-term plan in place, I don't think this recent correction or viral outbreak should derail that. Though I do think it makes sense to start building more of a cash reserve over the next several months and potentially over the next year for potential opportunities going forward. Building a larger cash position as a portion of your investment portfolio will also help balance the current equity risk you have in your portfolio. One of the first strategies is to know when and what to sell, if anything at all. Now, if you have any speculative stocks, short-term trades, or investments that you really don't have a long-term conviction in, it may be worth trimming those positions or potentially selling out of them completely to raise cash and help reduce risks to focus on the longer-term opportunities. But in my view, it still makes sense to hold on to your quality stocks that you don't need to sell, and ideally you would have bought them at a good price. Now, if you are not investing in individual stocks and are instead investing in index funds, understand that investing in index funds can work, especially during periods of market volatility, on the condition that you don't panic sell and continue to dollar cost average into the index funds over time. The main benefit of this is that you have a strategy in place where you're systematically purchasing more of an investment when valuations are lower and more favorable to you in the long term. So with one question being what to sell and when, the other question then becomes when to buy and what. Well, to be honest, this is the magic question, and I wish I had a magic ball to give you the definitive answer. Unfortunately, it'll be difficult, if not impossible, to know exactly where the market bottoms out and if this triggers a recession and exactly when. Considering both the short-term and long-term potential impacts of a viral outbreak, I think there's very much reason to believe that this could turn into a recession in the future. However, even if we don't see a recession, valuations are high enough that just the uncertainty surrounding the virus, the election, or any other catalyst could be enough to see multiples come down fairly substantially. So given that, as for strategies and tactics, assuming you've already built up a cash reserve, I would first think about your risk tolerance and what your long-term asset allocation likely would be suitable for you. Asset allocation being the proportion of your portfolio invested in different asset classes, including stocks, bonds, cash, real estate, and gold. Asset allocation is one of the primary methods that an investor can use to help manage risk in a portfolio. By diversifying your investments across different asset classes that aren't strongly correlated, it can significantly help reduce the overall volatility in your portfolio. So let's say that you're comfortable having a 60% allocation to stocks long term and 40% to other non-stock asset classes. If you're not already at that 60% stock allocation and have cash reserves to build that position over time, one strategy is you could earmark your cash reserves to be deployed at different tiers. For example, deploying some capital as the markets are down 15%, 20%, 30%, etc. The idea being you save more of that capital for the later tiers. This way you can gradually increase your equity exposure as the future risk reward becomes more favorable as the price declines. This is similar to dollar cost averaging, where in dollar cost averaging, you're simply investing the same dollar amount every time period. In this case, instead of having the time period be the condition for investing, you're waiting for stocks to come down to a certain threshold. This is generally the strategy that I like to use to help manage risk in my portfolio, at least when buying and entering into new stock positions. One of the biggest keys here is that it doesn't have to be an all or nothing approach of selling everything and then trying to time the bottom to get back into the market. Unfortunately, many people do this, and while a few do get lucky, the majority don't and would have been better off sticking to a less extreme strategy. For enterprising investors looking for opportunities within individual stocks, it can greatly help to build and create a stock watch list so you have an idea of the opportunities and positions you'd like to own at certain prices and can be ready to build and implement a plan to achieve those positions should you see market volatility that helps hit your buy targets. On another note, for many people, you may already have a relatively healthy allocation to equities or stocks within your portfolio, and maybe even more than you initially thought your risk tolerance could handle. If that's the case, you may consider adding to other non-stock investments like bonds, cash, or even gold in some cases. If you want more information on those asset classes and how they can help in diversifying your portfolio, I'll link to 3 separate videos on each of them within the description below. And one other strategy you can implement during periods of market volatility is simply to do nothing at all. And this may sound kind of dumb. Investors are human, and as humans, we tend to have emotional responses to various stimuli. Seeing your net worth decline by thousands of dollars during your lunch break, for many, is a pretty strong stimulus that can cause us to want to take some kind of action. However, unfortunately, many emotional actions end up hurting the investor long term, and is part of the reason why individual returns from investors over the last 20 years have lagged the market so significantly. As Warren Buffett has said, inactivity strikes us as intelligent behavior. The key takeaway here is that it's better to do nothing at all than to make rash emotional decisions. Either way, these are likely going to be very interesting and volatile times in the market ahead, and the market may be down quite a bit on the day this video goes up, but I'm curious to hear what your thoughts are and your plans are for this market volatility and potential recession. We'll see what happens in the comments below, and let me know your thoughts. Later this week, I'll be revealing my investment portfolio, and we'll be discussing some more long-term strategies to help manage risk and build a more robust investment portfolio that might help you sleep a little easier at night. If you'd like to be notified of that video, be sure to subscribe and hit the bell icon, and until next time, thank you so much for watching. My name's Michael, and I will see you in the next video.